You can see there's multiple here down at the bottom. Now, if I run it directly, for example, I'd have a 2,649% return. But if I use proper and I have to pay the 0.075, it drops down to 2,321% return. The next example is 1,974% return. If I run it on my own account, my own Hyperliquid account, and it drops down to 1,651% return. So if you have capital, I'd say more than $5,000, I think it's better to just run your bots on your own Hyperliquid account, opposed to using some prop firm where you're essentially paying to trade on simulated accounts. And that's the thing. All of these accounts are simulated. It's not even real order book. I mean, maybe it's real order books, but it's not. Your orders aren't actually going into the market. And that's the big difference between prop firms and just running your own bots. And there's really 3 numbers you have to look after if you are running bots for prop firms. They all kind of go like this. Essentially, they have a max drawdown. You can see this red line. It's -6%. You're done. This is from your starting balance. You're absolutely done. So when you're back testing, seeing if things work in the past, you have to make sure that you don't hit a -6% drawdown, or else your account's gone. If you paid $60 for it, it's gone. You got to start over. But then you also have the daily opens. So a drawdown on the daily open. And in order to win, to pass the evaluation, you have to hit the 10% pass or whatever it may be. It's different for each prop firm, but that makes it a little bit tricky in my opinion, because some bots, they do go into a drawdown that is bigger than 6%, but at the end of the day, they're winners. So that makes it a little bit tricky. And that's why I say, if you have $5,000 you can trade with, okay, do it on your own, opposed to paying for like a prop firm that you're trading simulated money on. And you have to pass these crazy goals. Now, I have some really well-picked examples because, as you know, I build trading bots every single day. So one of the RBI process, research, backtest, and incubate, the second piece of that is backtesting. So I've got a lot of stuff that works in the past and a lot of stuff that works in the future. And you can see that I use some of those liquidation strategies that I've shown multiple times on this channel to compare if they could pass these prop firm rules, because they're different, right? If the drawdown is too high, you're done. You lose all of your money, whatever you put in. So in this example of the code that I will show you, every death came from one rule. A lot of these passed the entire thing. You can see 395 simulated evaluations, and the 6% drawdown killed none of them. So these are fairly good strategies. I don't know what your strategy is, if it can actually pass, but you have to take it into account. You have to, when you backtest, there's that drawdown, that daily drawdown and the total drawdown. But 16 of these, they did not pass, and it was because of the 3% daily loss. Now, if you're an algorithmic trader, you're not really looking at that 3% daily loss. So it's like a whole nother element to this game. You can see I have 5 different tests here, and most of them passed, but it depends on the week, right? So a couple of them did not pass depending on the week you started it at. So that's a tricky thing. Like, it could be a good strategy that works for years on end, but it didn't work one week, so you don't pass your evaluation. This is like a whole different element to algorithmic trading that I personally have never really thought about, because this is an anchor that's brand new. You have a $60 challenge, $500 challenge. Okay, 96% pass, but some weeks they won't pass. And these backtests I'll be showing you are pretty interesting because you can see 3 pass forever, like 522 days.